Buying a home? Watch this before you get a mortgage. Welcome to our channel. Today, we're diving into the top things home buyers are looking for in a mortgage. Whether you're a first-time buyer or looking to refinance, these key factors can make all the difference. We're going to break down everything you need to know so you can navigate the process with confidence and get the best possible deal on your mortgage. Let's get started. Chapter 1, interest rates. The silent killer of your money. First up, let's talk about interest rates. A seemingly small difference in interest rates can result in tens of thousands of dollars more in interest payments over the life of your loan. Let me show you an example. Let's say you're taking out a $400,000 mortgage. With a 6% interest rate, you'd end up paying over $433,000 in interest over 30 years. But if you snag that same loan at 5%, you'd save over $70,000 in interest. That's a massive difference. So how do you score a lower interest rate? Well, it's all about boosting that credit score. The higher your score, higher your score, the better the rates lenders will offer you. Don't just settle for the first offer you get. Negotiate, compare, and make sure you're getting the best possible deal. Chapter 2, loan terms, 15 versus 30-year mortgages. Next up, let's break down loan terms. The most common loan terms you'll come across are 15 and 30 years. A 15-year mortgage means higher monthly payments, but a lower overall interest rate. On the other hand, a 30-year mortgage gives you lower monthly payments, but you'll end up paying more in total interest over the life of the loan. So which one's right for you? It all comes down to your financial situation and goals. If you can swing the higher monthly payments and want to be mortgage free sooner, a 15-year mortgage can save you a lot of money in the long run. But if you prefer lower monthly payments and want more financial flexibility, a 30-year might be the way to go. Chapter 3, breaking down your monthly mortgage payment. Now let's dive into what makes up your monthly mortgage payment. It's not just about the principal and interest. Your monthly mortgage payment typically includes 4 main components, often referred to as PIT. P stands for principal. This is the actual amount of money you borrowed to buy the house. I is for interest. This is the cost of borrowing that money. T is for property taxes. These are annual taxes you pay based on the value of your property. And lastly, I is for homeowner's insurance. This protects your home from damage caused by fire, theft, or other covered perils. Chapter 4, down payment. How much do you really need? Now let's talk about the down payment. The bigger your down payment, the less you have to borrow, which means lower monthly payments and less interest paid over time. Traditionally, a 20% down payment has been the gold standard. It shows lenders you're serious about buying and reduces their risk. Plus, it helps you avoid private mortgage insurance, also known as PMI. But don't worry, there are options out there if you can't quite swing that 20%. There are loan programs that allow for down payments as low as 3% or even 0% down in some cases. Chapter 5, closing costs, the hidden fees of buying a home. These are the fees and expenses you pay on top of your down payment when you finalize your mortgage. Closing costs can include things like loan origination fees, appraisal fees, title insurance, government recording fees, and more. These costs can vary depending on the lender, the size of your loan, and where you're buying. On average, you can expect to pay anywhere from 2 to 5% of the loan amount in closing costs. You can ask the seller to contribute towards closing costs, negotiate with the lender for a lower rate or discount on fees, or even shop around for different service providers like title companies to compare costs. The little effort here can save you a lot of money. Chapter 6, finding the right type of mortgage for you. There are several options, each with its own pros and cons. The most common types are fixed rate mortgages and adjustable rate mortgages. With a fixed rate mortgage, your interest rate stays the same throughout the life of the loan. This makes budgeting predictable as your monthly payments will remain consistent. It's a great option for those who value stability and plan on staying in their homes for a long time. On the other hand, an adjustable rate mortgage or ARM has an interest rate that can fluctuate over time. ARMs typically start with a lower introductory rate for a set period, but after that initial period, the rate can adjust based on market conditions. Chapter 7, credit score, your ticket to a great mortgage. Your credit score is like your financial GPA. The higher your credit score, the more favorable loan terms and interest rates you'll qualify for. Think of it this way, a good credit score is like having a VIP pass to the best mortgage rates. So what credit score do you need to buy a house? Well, it depends on the lender and the type of loan you're looking for. Generally, a credit score of 620 or higher is considered the minimum for conventional loan, but to snag the most competitive rates, you'll want to aim for a score of 740 or above. Now, if your credit score isn't quite where you want it to be, don't worry. There are steps you can take to improve it. Start by paying your bills on time every time. Also, try to keep your credit card balances low. Chapter 8, getting pre-approved. Shop for a house with confidence. Before you start seriously house hunting, it's smart to get pre-approved for a mortgage. This is like getting a sneak peek at what you can afford and shows sellers you're a serious buyer. During the pre-approval process, a lender will review your financial information to determine how much they're willing to lend you. Having a pre-approval letter in hand gives you a competitive edge in a hot market. It shows sellers that you're qualified and ready to move forward, which can make your offer stand out from the crowd. Chapter 9, choosing the right lender for you. Not all lenders are created equal. Just like you shop around for the best deals on cars or clothes, it's crucial to shop around for the best mortgage lender for your needs. Take your time, do your research, and compare offers from multiple lenders. Look for a lender with a solid reputation, competitive rates and fees, and excellent customer service. You want to work with a lender who's responsive, transparent, and makes you feel comfortable throughout the process. Remember, this is a big financial decision, so you want to feel confident and informed every step of the way. Chapter 10, repayment flexibility, paying off your mortgage faster. Some lenders offer options like bi-weekly payments or extra principal payments, which can help you pay off your mortgage faster and save on interest charges in the long run. Bi-weekly payments involve making half of your mortgage payment every 2 weeks instead of one full payment each month. This results in making an extra full payment each year, which can significantly accelerate your payoff timeline. Making extra principal payments is another great strategy. By putting any extra cash you have towards the principal balance of your loan, you reduce the amount of interest you'll pay over time and shorten the life of your mortgage. Flexibility can be a game changer. Congrats. Now go find your dream home. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on home buying and personal finance. See you next time.